Are real estate and businesses funded in the same way? This is a very cool question. Thank you for sending this one in. Uh, I spent the first several years of my career doing syndication and putting deals together in that way. The last 10 years have been in funds and so forth. But in the middle, those 20 years in the middle, I was in venture capital. And all these deals are effectively syndicated in exactly the same way. They're 95% the same. There are some small differences, but those tend to be structural differences, the way that shares are organized and so forth. So let's take a quick look at this and see if we can't, pull back the curtain on a couple of things to give you the inside track. So here's how this works. Number one, in every one of these situations, you have to take a look at what's the reason that someone is investing. In real estate, they're investing for a share of the profits and for a little bit of escalation in the upside. That's what they're hoping for. So when you structure these transactions, what you're going to do is you're going to put together basically a private placement and an operating agreement and the whole transaction, so that the investors get a percentage of the profit that gets made. That's really their objective. There isn't any other grand scheme that's planned on for real estate. You buy it, you fix it, either you hold it and you milk it for cash flow, or you sell it and something else happens in the future. That's it. So investors really, although they invest and they get a percentage of the partnership, they don't really that much care so much about what their percentage of ownership is, except for that there are concerns about voting and other things. So the percentage that they own matters in that way. But for the most part, they just want to know that their percentage of distribution is going to be consistent and that the percent that they get on liquidation is going to work out in their interest. And they're going to get a reasonable return. In a venture type of transaction, the goal is not the same. The goal is not to milk a business for cash flow. The goal is generally to grow that business, escalate its value, and then sell it for many times its value at some point in the future. A lot of times in venture, it was through an IPO, through a sale to another company, or typically that's the two for that category. And if it's an ongoing business, there could be a couple other ways it could sell. It could be sold to a competitor. It could be sold to a big company. It could even be sold to the company's employees on a stock option or a stock employee stock transaction. So there's a few ways that this can happen, but the primary difference between syndication of real estate and syndication of, say, a startup, a technology company, really has to do with what the long-term goal is. Now, there are a few other differences. So in a real estate transaction, we have a waterfall that says, first thing we're going to do is we're going to get you your money back. Then you're going to get a preferred, where you're going to get a preferred, you get paid first. I mean, there's different ways that those hurdles and waterfalls work, but typically the investor is going to be paid something first. The promoter is going to be paid second, except the promoter is probably going to get some fees before the preferred starts to kick in, and they'll get some real estate fees. Venture transactions don't have the same fee structure. They probably are going to give a salary to the promoter, whoever the person is who becomes the president of the company. They're probably going to put them on some payroll because they're not going to be rendering traditional services like brokerage services, mortgage services, and the rest. So they're going to be on more of a traditional kind of arrangement, and they're going to be really more of a business that they're going to be employed by the business that they end up creating. That's one of the conflicts of interest, by the way, is a lot of times these startup founders are, they take a lot of the capital out of the business that they raise. And that's something that the investors are very sensitive to. They become overhead to their own deal. In real estate, we don't really become overhead to our deal because we have to hire a real estate broker anyway. We have to hire a mortgage broker anyway. We have to hire a property management firm anyway. So if we can render those services, then we might as well render the services and the investors pay us. But at no time does it really become overhead. And that's the reason why things like asset management fees are things that I dissuade our people from doing when we put together these deals, because that's just pure overhead. And that's something that investors generally do not like. So there's more significant differences. You kind of get into the weeds. Businesses are much more complex to put together. The money is much harder to raise. It's a whole different world. Structuring them is a little different, and you have to really think through some bigger issues. Real estate and real estate related projects are a little bit more simple, and they're a little bit more straightforward. It's a little easier to think through them because there aren't as many options for putting them together, for exiting them, and the logic and the reason why people get involved is much lower. And by the way, the incidence of failure is a lot less in real estate. I mean, the likelihood of you being successful delivering 8 to 15% a year to your investors is pretty consistent and pretty high. You're probably going to be able to succeed at that. In a venture transaction, it's 0 to hero. So, you might be a hero or they might get back 0. And that's kind of the way it works. So big differences between these things. Thanks for submitting that question. If you have a question, please submit it to us, because our goal is to help you to excel in this business, because we believe the syndication and the fund business are great businesses as long as you go out and stake your claim.